interest rate of microfinance institutions. It's a fact that microfinance loans are expensive, costlier than the bank loan, and there is a reason for that, which all of us knows. Because we are doing this double intermediation. We borrow from the banks or the financial institution and then lend it to the down below. So there is a double intermediation cost. You have a operational cost which is higher than the normal financial institutions. There is a risk involved in it because it's all non-collateral loans. So, and there is a growth required for the institution. So definitely the cost is going to be high. But then how much high and how much low it can be? This is a debate which has been happening, and everyone, as I said, has a view on that. But the view is mostly that microfinance institutions are charging high. But nobody can say how much should be the rate actually to be charged, which nobody says, but everybody says it's a high. Even Reserve Bank of India, when we talk to them, they talk about higher interest rate. But if you ask them to indicate a number, they will not say. They'll say it's up to the institution to identify the number. So we were having this discussion on October 23rd when National Conference of Sa-Dhan was happening. On the sidelines of that conference, we had a meeting of some 30, 35 institutions who were present, mostly CEOs. And that time it was suggested that Sa-Dhan as an SRO should come out with some kind of a template which can be made use of by everyone so that nobody can pinpoint us and nobody can say something is wrong with what we are doing. So accordingly, we had some deliberation within the industry persons, senior people, and we have developed something which will be discussed today. And we would like to get the views of everyone on that further fine tuning and making it better, so that finally we would be issuing it as a directive to all everyone, so that everyone can make use of this as a policy of theirs. Basically, what we have done is that we are trying to identify what are the costs actually involved as far as for working out the interest is concerned. So we have a cost of borrowing, we have a cost of operations, we have cost of risk. So what are the different costs we should involve in there? Because one of the point which RBI CGM also told was that many of times this is not properly worked out. I mean, in fact, the CGM was very clear. She said that we are not here to indicate any number. It doesn't matter whether it is 21, 21 or 22 or 23, but that number should be clearly defined and should be properly worked out, number one. Number two is that they also said that the some of the cost which is taken for the purpose of, especially in the operational cost or even in the cost of funds also, some of the costs which are slightly higher, or it is something which is not justifiable. So what are the elements we can bring in? What are the components we can bring in? That those kind of a discussion, if we can have, we can finally finalize this template and we can circulate to everyone. So this is the objective of today's this meeting. So I welcome each one of you, and I request Sadaf, who is a board member, co-chair of Sa-Dhan, and also a senior member of the fraternity, to give his view on this. Thank you. Over to you, sir.
Thank you very much, Gigi sir. You put out the context in very well. I think it is imperative and very important to mention here that pricing has always been a sensitive topic. If it not for the regulator, politically also it's a very sensitive topic. So we all have to be conscious, and we have to be responsible about how we do implement the policies. I think for long we were following a margin cap regime. There was a 10% margin cap for large entities, and then there was a 12% margin cap, which was implemented post the Maligram Committee and refinement of the Maligram Committee recommendation of 26% pricing. So I think now we have moved in an era where RBI has considered us as a responsible institution and responsible industry, and they have freed the pricing. But I think what comes with the freedom is also comes as a responsibility, that whether we are actually using that freedom correctly or we are abusing that freedom. I believe in our industry, nobody, I can't say for everyone, but at least by 99.9% everybody is of the same opinion that we should charge fairly, we should not charge exorbitant interest rate. But what happens usually is that because there is a complete freedom on pricing, the interpretation of the regulation is varied at different institutions. So this effort of webinar is to harmonize that understanding of the pricing. So there, we all know there are four components of pricing, which is your cost of fund, your credit cost, your operating cost, and your margin. But at the same time, how cost of fund has to be calculated, different institutions follow different approach. Also, credit cost. There are institutions who follow the ECL guideline because of India AS. Certain institutions who are still on IGAP, how that has to be calculated, that needs to be standardized. Thirdly, operating cost, everybody knows by and large it is same. But fourth, which is the margin, what should be the ideal margin? That is also based on your board's recommendation. But what RBI is looking at is that there should be a risk-based pricing, because one of the key element of their deregulation is that it should be risk-based pricing. So it should not be one size fit all kind of strategy, that is one price and you apply to all customers. When you decide on the pricing policy, it should be a range. I'm just giving a hypothetical example, 23% to 23.5% or 23.75%. It's a range between, and where you are differentiating that, okay, a new to credit customer, you are charging this, or existing customer, you are charging this. So I think that is also very important. We have observed that where there was a standardized pricing, there RBI has taken a view that this is not the right spirit or recommendation of ours. And most importantly, once we finalize our policy and we implement this, our board has approved this, we have to follow that, and we have to every quarter, according to that policy, revise our prices. So at many places, it is found that pricing policy has been adopted by the board, but actually, in the ground, the policy, the pricing that we had fixed at the beginning of the year, it continues to be till the end of the year. Because your cost of fund is dynamic based on your borrowing cost and based on other elements, credit cost, it is coming out. So it has to be every quarter reassessed, and if the pricing is matching the requirement, then we should have to go with that. Otherwise, we continue to revise downwards or upwards, however it is, downwards more preferably. That is what RBI's expectations are. And it will become even more sensitive when we get into a kind of a declining interest rate scenario, because it was widely anticipated that in December policy meeting there would be a rate cut. It hasn't come through, but most likely in February
हाँ जी,
policy meeting there would be a rate cut, and
क्लास किस फ्लैट नंबर के लिए
there would be
भेज दीजिए ठीक है।
there is some disturbance here.
Please switch off your mics. Those are not speaking, please.
Yeah.
Sunny,
So
is that Sunny?
We're trying to do it.
Oh, okay.
We're trying to do it.
Okay, okay.
So there would be like an effort or the expectation from the RBI that if there is any rate cut, the benefit of that rate cut is passed on to the customer. So there are two, three aspects of this. One is, of course, the hard numbers, which we are trying to take you through. But then there are softer aspects of it also, which is how do you communicate and how do you transmit the benefit. So if your policy at the board level itself says that any benefit out of cost of fund reduction, we will share with the borrower, it itself conveys the meaning that you have an intention. How much you do is based on your formula, but at least if you put that as a guideline, then that will give a lot of comfort to the regulator that at least the entity is looking on sharing at the benefit of reduced cost of fund. Not entirely 100%, but at least some portion of it you are passing on. So those are things which are also important. I
Right.
think that also has to be taken into consideration. And I can give you a larger perspective why all of this is happening and why we are also seeing so much of scrutiny and delinquency. The reason basically is that post-COVID, every household had some sort of a reduction in income. A member lost a job, or a business that they were into, their income reduced. And usually, what happens, just like us, when we fall short on our cash, then we borrow through credit. We swipe a credit card, a rural household borrows from the market. So they borrowed loan, and that's why you saw a huge surge in growth of microfinance loans. But that cash flow management can happen only up till a time where your income catches up. But rural wages, unfortunately, for the last 5 years have almost remained stagnant, or the growth is such that inflation basically eats into it. So real wages are actually negative 0.04% in last 4 years. So the income has remained the same, but at the same time, to match the cash flow requirement, people have borrowed money. On top of it, what has happened is that food inflation has come in, and food inflation is such kind of an element which hits everyone, because you can avoid if there is a luxury item, but basic food necessity like vegetables and dals and everything, the rural household has to feed. So what they do is not utilize that money to buy food and deprioritize repayment. And among repayment, what comes first in lowest in the priority list is the unsecured repayment. And that is how what is playing out today. And that is why RBI is also worried about unsecured loan, and that is why they are making kind of a recommendation to slow down your growth. And apart from the growth, one way to reduce burden on the household is to reduce interest rates. And that is why RBI is coming hard that there should not be usurious interest rate. Interest rate should be reasonable so that the rural household can afford to repay loans, and it is overall for the good of the our repayments and good for the portfolio. That is why RBI is coming. So we have to take that in positive spirit.
Right.
Uh, and of course, it's a dialogue. What we are trying to do is put out a structure here based on the feedback, based on all the recommendation. We will roll this out for everyone, and there would be standardized format. So there should not be two interpretation of the same guideline. There should be one uniform interpretation. And if there is any gray area, then of course we can discuss and plug through circulation or circular issued through Sa-Dhan. So that is the attempt of what we are trying to do with this call. I think that's all from my side. I'll hand over to Sa-Dhan team there. They will project and take us through the formula and take further discussions. Over to
Thank
you.
you, Sadaf sir, for your wonderful perspective of the entire scenario of microfinance sector and the current situation. So we now walk through that template, and you can also give your views after the presentation is done. We will give how we have arrived at this template, and what are the justificate, or what are the points which have taken to account for preparing this. If anything is missed out, anything is different, you have a view, please make it clear so that we can finally create one which will be useful to everyone, and a more standardized and harmonized one. Thank you. Yeah, over to you.
So as you can see in the screen, I hope everyone can see the screen. We have prepared a template in a discussion with few of our members how to calculate the interest rate. So first, as Sir also said, that cost of fund is a major component. Here we are taking four major parts of cost of fund. One is the net interest cost of borrowing of term loan. So whatever term loan you have received, uh, the interest you are paying to the lenders uh, deducted the interest you are getting from the deposits and FDs kept with the lender. So that is how we are calculating net interest cost of borrowing. Similarly, for working capitals and commercial papers also, net interest cost of borrowing, and also for bonds and debentures and external borrowings or ECBs, external commercial borrowing. So apart from that, we are also taking the cost of arrangements of funds, documentation, stamp duty, other charges which has been you have to pay for the to raise the fund, and these costs have to be amortized over a year. The
So in
cost of
simple terms, just to amortize means like you have to, if the funds are raised at a say a processing fee of 2%, but they are raised for 5 years, that 2% has to be spread for 5 years. You cannot add that 2% immediately to the current year's cost of fund. Yeah. Carry on.
Thank you. So the actual cost of fund has to be is in a percentage format, which is the sum total of these above four components, and each of the component has to be divided by the respective monthly average outstanding borrowing of that particular type of fund. So this is the cost of fund calculation. Apart from
Net interest cost is that of, see, what you have borrowed. Like suppose you have put it in parked it in a bank account or put it in a place where you are earning something out of that, that can be netted out. That is what it means, net means. It can be for the borrowed funds, it could be for the fund raised through the bonds, it could be borrowed from, raised through the ECB, whatever means you have borrowed. Because when you get a bulk of fund, you don't deploy everything immediately. So something may be placed in a bank account or a deposit or something of that sort. So that yields you something. So that is what it says, net of.
The second component is the operating cost, which is the straightforward your cost of establishment, as you have shown in the your balance sheet also, that, and also the cost of salary and payout payments. This two has to be taken, and this has to be divided by the monthly average outstanding AUM of your organization. So here we have to add one point, that your salary and payment payouts to your management should not be so skewed that it looks unnecessary high. Dilsa, do you want to add a few lines?
Basically, operating cost is any cost which is there for your when operations are concerned. Your loaning and disbursement, collection, whatever cost involved around that, that can be the cost in an operating cost when we are talking about. What Sri was trying to say is that sometimes, in one or two cases, RBI was pointing out that some costs which were apparently looks like nothing to do with the cost of operations. That somebody that the CEO had a travel abroad, something of that sort, which was also brought into that. So probably whatever the component you take, it should have some relevance to the business you are doing, whether it is lending or collection or other things which are around the lending activities.
Yeah, Shams, I think there is a question on the first part of the component, that is the arranger fee.
Yes, sir.
So somebody
so-
named Chintan Desai has asked, the arranger cost, do we need to add arranger cost as well? RBI has a different view on this.
See, it's a cost. If the money is raised with the help of an arranger, I don't think there is.
Sir,
Yeah, please tell.
Yes, sir. Recently, RBI has visited our office, and while you are in cost of funds policy or interest policy, they have asked us to revise and not to include any cost which is, apart from interest, processing fees, documentation, stamp duties, and other charges. in fact, they would like to not add the interest swap for ECBs and hedging premium that has been paid to them. So what we have to do is we have to revise the policy and we have to remove the arranger's cost from the cost of funds, and we have to add it in a operations or OPEX.
Okay.
Yeah.
So other side,
Yeah, so I think one way or the other, it will come into the cost structure. So whether you add it in OPEX or whether you add it in cost of fund,
No,
but
Sadabji, but there, Sadabji, there is a difference.
Chetanji,
But
just one sec. What our interaction, different auditors of RBI have different interpretation. So what our interaction was that anything which is directly attributable to the raising of funds can be included. But it should be directly attributable. It should not be something else like you are issuing some shares for in lieu of your funding that you are receiving or anything. Those things are not. But if you're paying some fee which is directly attributable to the size, quantum, tenor of your fund, then it can be included. That is what our interpretation is. Again, I think coming back to your point, either you include it in operating cost or you include it in cost of fund, it will ultimately come into the cost structure of the overall loan.
Right. Okay.
Carry on, Shamshi.
Any view on the operating cost?
Sir,
Okay.
sir,
Yes.
this is Bishri from Uyghur Financials Limited. Actually, I have two questions. Already one question has already covered. So my first question is why we should less or minus the interest accrued of the security deposit against the borrowings. My submission is we are taking 100 loan from bank. So we have given 10% security. So these 10% are our fund. We are paying 100% just 12% margin. So we give 12% rate of interest on 100 rupee. So
You're talking
these,
about the net interest cost.
so why should we just minus security deposit? Security deposit is the alag part, no?
So, Sadar sir, please correct me if I am wrong. See, what it means is that the money which you are raised, if it is parked in a account and if you get some yield out of that, that can be netted. Am I right?
That is what the expectation is because they are looking at effective cost of borrowing. And if you're using the same money to earn something through a fixed deposit, not your regular operations, then that has to be netted off. That is what they're saying. Typically, what happens in, especially like an OD type of facility, like OD is drawn, then whatever is drawn, the interest is calculated in that only. But here, the money is entirely disbursed in a term loan in one shot, and that money is not utilized and it is kept somewhere where it bears an income, even if it is a FD interest or whatever saving interest or current account, no interest is there. So that has to be netted off. That's the interpretation that RBI is coming with.
So we should just minus this interest accrued on security deposit. Yes, sir.
Yes.
Don't deposit.
Fine. I have no bargaining. It's okay. And
Money you are received in bulk, if it is part of it is kept in some bank account, and if that yields something, it's a more utopian way of thinking. But then this is how that's what RBI decides to have it.
much. And can you consider our just rating fee or grading fee in cost of fund?
Yeah, duty and other charges includes that.
Yeah.
No, I am talking about rating or credit fee, rating fees or grading fees.
That will come
Specific
into
to that
operating cost, no?
facility. If you are getting say a PTC rated, then for that PTC, whatever fee you are paying, you can include that in calculation of cost of fund, but not an institutional rating. Like if you are getting an institution rated annually once, that can't be attributed here.
That can go into operating cost, I believe.
Yeah.
No, just what we are reading. We are very small organizations. That's why I am asking the questions. Sir, don't take it other way.
No. This is a
We have rated our organizations for getting fund. So that's why we can keep it in the cost of money fund. Yeah, we don't put it the cost of coca and others, but the grading or rating fee you have also mentioned, so we can just include in here.
Sure.
Okay.
Okay, next.
And sir, I have another question. Then I have no other questions. I just one question, that is risk cost. If you just elaborately discuss the risk cost, what component will be taken here, that will be good for our understanding. Okay. So please go ahead and just try to say something about how we can come on risk cost. Yeah.
So, Vishwanath, sir, are you talking about the risk cost
Yeah,
on
so in this operating cost, after that, there is a risk cost.
Yes, sir.
Basically,
What
risk
component
cost.
we can just consider for risk cost?
Yes, so we are coming to that. Shamshi, you have any comments on the operating cost? Otherwise, we can get into the risk cost.
I have one query with regard this cash margin on borrowings. Some banks are, it will be in the form of fixed deposit. In other words, some NBFCs are charging as a security deposit where the interest is not there. In fixed deposit, interest is earned, whereas in security deposit, interest is not earned on the cash margin.
So
How to
if interest is not done, nothing to be netted off.
right.
You're not getting means you're not getting.
So, any other question on operating costs or cost of funds?
No,
So
no. I have no
this
question.
is this is Prashant from SEFL. I just had a query. Now there was some doubt about the categorization of a cost, whether it would come as a like travel cost, whether it would come as a cost of salary or operating cost. Now, if there's a vagueness or there's a lack of clarity about the category of the cost, can be, if anything is left behind and we are not able to put it in the cost of salary or the operating cost because they are very specific costs, can we put it in administrative cost so that the three costs together come to the total cost incurred?
See, I would only say one thing. Good governance and governance is not really what the law is. Governance is what is above the law. What you're following is the law. So what Gigi sir was trying to say, that you should not put any expense in the operating cost which is not really directly related to running the business. So if anybody in the promoter's family or somebody is going for a holiday, personal holiday, and that also comes as a operating expensive or administrative cost, that's not really a good governance. But if it is directly attributable, like you are going for a business meeting and you are going for a road show or something abroad and that is coming out, that's perfectly fine. That's what we are trying to say. Of course, it is up to the interpretation of the every individual and organization. But in good spirit and good sense of governance, we should only put those things which are directly attributable to running a business.
The point is that justice not only to be done, justice should be seen to be done. So you
Travel is
have,
just an example, nothing like it could be related to any other thing as well.
so whatever the cost you feel that is relating to the business, relating, raising funds, collection, anything relating to the business activities, if it comes, definitely it can come. There will be salary, there will be travel cost, there will be rent cost, there will be some kind of incentives being paid, everything, those kind of things, whatever is happening around the business, they all come as part of the operating cost.
Understood. The question was based on the assumption that only business-related costs would be included in the costs.
Yeah.
Thanks
Can
a lot.
depreciation be the operation cost? One question is that can depreciation be part of the cost?
Depreciation, yeah, if it is.
Depreciation will be part of the.
It's part of the business. It can be.
How do you take it, sir?
It
Depreciation.
comes in administrative cost. It is amortized to the life of the asset, and it comes there.
Yeah.
It's amortized for the, how many years? Life of the asset.
Life of the asset.
Okay, okay. I think we have to see when we separate this,
We'll have to put
Give explanation.
explanation.
Yes.
about this. Okay.
So the next component is the risk cost,
Right.
which is as Sadhu said that some of you are using ECL, expected credit loss, but some of you are still using INFAM. So whatever you are using, whatever system you are using, you should use that to calculate the risk cost. So either based on the ECL, or you can, if you don't have any system like that, it can be incremental provisioning, which you have mentioned in your balance sheet, should be used as a risk cost.
See, all the NBFC MFIs are now moved into the Ind AS. And for them, the ECL is a very, very clear way of indicating that. If they are not bad debt, write-off shall not be part of the risk cost. Bad debts write-off.
Write-off is a part of a credit cost. So whatever you're incurring as a provision and write-off is a part of a credit cost.
Credit cost.
Just my question, sir, please. One first write-up will be come under credit cost, and just provision. Just in our case, we are provisioning 1% of outstanding. So that 1% will become and write-up will become. Okay.
Yes,
Yeah.
sir, this is pricing for the future. So this is not about the past portfolio. You can assume based on past portfolio what is your credit cost traditionally, but you have to predict what is the credit cost in future for you. So 1% is the provision requirement that RBI has given.
Right.
But if you assume that 1% would be your future credit cost, then it's fine. But ideally, it should be like ECL method, which looks into the past performance of the portfolio, gives you a probability of default, gives you a LGD, which is loss giving default, and it arrives at a expected credit loss. So if a PD LGD is calculated, that would be the ideal way. I think that is what we should follow.
But those who are not following ECL method, of course, the provisioning, additional incremental provisioning is what to be taken as a risk cost. And of course, write-off, if there are any, that will be
That
part
has
of
to
that.
be included.
So there was a question whether the depreciation should come in.
That is in under operating cost, as we have discussed. And then
Life of the asset.
Yeah.
so net margin, it has to be either based on your return of asset or whatever your board have decided.
Security deposit is to be reduced from the expenses. What is it?
As in interest rate on security deposit is to be reduced from interest
The
expense.
borrowing will be gross borrowing. And interest would be, of course, the denominator will remain as the gross borrowing. I'm responding to Rohit's comment.
Okay.
Okay, so
Can Rohit, what is it?
Okay, so thanks.
okay.
Okay.
The percentage of credit cost will be same for the whole year, or it will be changed quarterly.
So credit cost assessment you have to do every quarter or as per your business plan and budget that your board approves. Based on that credit cost you have to apply. The only thing that here recommendation is this is a varying item. So you may assume a credit cost like at the beginning of the year, if you were doing planning in March 2024, you would assume the same trend to continue. But in 6 months, lot has changed in the industry. So your expected credit cost might go up. So based on that, you have to plan. So ideally, quarterly is better if you can publish quarterly. And Sa-Dhan is also mandated to publish the interest rates of the members quarterly. So quarterly would be better. But it depends upon institution to institution. Ideally, quarterly is what is recommended.
See, if you're assessing the credit cost, if you're assessing the provisioning, additional incremental provisioning on a quarterly basis, it should be quarterly. If it is done only on a yearly basis, then of course it will remain for the entire year.
So there is another question.
Hello, sir.
চলে আসো ঢুকে যাবে ছেলে কোনো একটু নক করে ঢুকে যাবে
Hello.
There is another
Tushar
question.
here.
Can you switch off, please? Those are not talking.
Hello, sir. Tushar here, sir.
Yeah, Tushar, tell me.
Sir. Sir, actually, we are doing the pricing calculation quarterly, but the credit cost we are taking for the whole year, for the whole year. So we are taking the same credit cost, like 3% if it is cost.
Any assessment in between? Quarterly, you're not making any additional assessment of your provisioning requirement. Is it?
No, we are not doing that. But
It's fine.
we are calculating every quarter. But as far as like credit cost is concerned, we are taking for whole year. So is it okay for?
See, in a scenario like today, you will be worse off. In a scenario like where everything is good, then it's fine. But in a scenario like this today, where the credit cost is increasing and you will be worse off. It is recommended that you do it quarterly, but based on your own pricing policy, you have to decide. Ideally, the pricing policy should state that you will regularly monitor it.
Okay. So like what is the method of calculation of this credit cost? Like sir, like we are doing like the expenses, what are the provisioning we are doing in the P&L divided by the AUM, matlab asset under management of last 7-8 quarter.
Now, how do you calculate the provision? Provision is calculated based on
Yeah,
your expectation of
yeah,
delinquency.
that's ECL we are doing.
Yeah, so that is what it is. So ECL, expected credit loss, that is what it is.
Yeah. So, but like that is the amount, or like we have to calculate the credit cost like some like impairment divided by some AUM, the AUM of the quarter.
It's a percentage. Ultimately, we are calculating the whole thing in a percentage, and we are calculating that okay, our overall cost is coming as cost of fund is say 14%, operating cost is another 6%. Your credit cost is 2%, and your 2% margin. Based on that, will form the whole lending rate.
Okay.
See the question. See the other questions.
So there is a question is that while calculating the DSCR, should we add the interest of the loan to both the numerator or the denominator?
Only numerator. Why would you add interest on denominator?
And then can ideal cost of fund to maintain liquidity majorly due to LCR be considered as cost component?
Yeah. LCR has to be maintained. That's a statutory requirement. So it can't be. Your overall liquidity will be a component of LCR. As we need to reverse the interest income on NPA, income thus reverse on NPA loan can also be factored into risk cost. Credit cost is basically all your provision. So reversal of interest can't be. Provision plus write-off is the credit cost. And reversal of interest is not. If you go through ECL method of accounting, even if an account is NPA, interest can be accounted for.
So the average AUM outstanding time period is we are requesting monthly average of your outstanding AUM outstanding.
Yeah, monthly average is the best.
Any other further question from anyone?
So what we will also request you that you can send us a mail on our SRO mail ID, SRO at Sa-Dhan.org.
First, we'll send this. We'll send this template out.
So, no, if there are any further things to be clarified in that, has to be elaborated or explained, that can be made part of that. So if anything is there to be, you want any particular
All inclusive cost for goods will be the same as the ROI. All inclusive cost, you have kept a cap of 60. So it will always be less than 60.
So when you are telling us something,
ROI आप कह रहे हो अगर 42 दे रहे हो तो रिजेक्ट कर देना.
no, we are not able to
I think
understand.
he is having a conversation internally.
Okay.
So someone has asked for risk cost, should we consider the add-on provisions for the period or the closing provisions?
Lending raise is forward-looking. So what you are planning for the year. So of course your previous year's credit cost becomes a base, but provision is on forward-looking. So what we are planning for, say March 2025, what should be our provision cost should be included in the pricing of credit.
So we have anyway circulated this. We will circulate this again. Achha, there is another question. Cash margin, cash collateral is charged on our capital. The same, if utilized in general course of business, will earn more income. Hence, should it not be reduced from gross borrowing?
The gross borrowing is your interest-bearing liability. So that you have to include totally, and your interest is there on the borrowing that is there. Cash collateral, if you're earning anything, that has to be netted off. Otherwise, denominator would be total borrowing.
Sir, actually, in the earlier guidelines in the handbook of microfinance, earlier we used to follow that. No, in that case, the cash collaterals were deducted from the borrowings. That was the system earlier, and this 10%, 12% margin was there. Now, why do we have to deduct only the interest? It should be deducted from the gross borrowings.
No, I don't remember cash collateral being deducted ever.
No, earlier that was a formula was given by RBI only. Earlier we used to follow that guideline.
See, here we are talking about the interest portion, right?
No, sir, cash interest on cash margin or
Denominator is saying if there is 100 crore borrowing and if there is a 5% cash collateral, then on the denominator we should take 95 crore only. That's what you're saying, right?
yes, that was earlier this thing.
No, here what we are saying is that you take 100, what is the cost you have to pay, and for the 5, how much is your earning? And if you are earning something out of that, you can net it out. Similarly, the 100 crore which you have received, if you have put 50 crore for the use of next year, or next month, or month after that, that if it is earning something, that can be also netted out.
So this cash margin is met out of our capital.
Correct. So
if we deploy that for our lending, it earns us nearly 24-25%. Here, interest means we are earning only 5-6% interest. There's a lot of difference will be there.
Yeah, on the denominator, you can't deduct it. It has to be the 100 rupees that you borrow, that 100 rupees has to be denominator. And I don't remember it was ever there. If you can please circulate if there is any recommendation from RBI, we can have a look at it.
No,
It
I
was there in
think
the Sa-Dhan handbook.
Sadhavji, there was one circular which RBI has accepted in the similar lines what Sa-Dhan is saying now. It was done by the MFIN. Similar kind of a exercise, and all cost of funds minus whatever you are earning on the interest, that needs to be reduced. So only the cost of, to derive the cost of funds, denominator will not get changed. What you have to do is net finance cost. All expenses minus the interest earned on the fixed deposits needs to be deducted, and it has to be divided by the gross borrowing and not net borrowing. That has been accepted by the RBI in 2012.
Yeah, so we are talking about only denominator. So denominator
Yes.
remains
So
the
it has
same.
to be gross. It has to be gross.
What Chintan says is what we are saying is also correct.
Yeah.
So Malcolm, I don't know whether from where you got the other information. If you have
It was
something,
Sa-Dhan handbook.
You
Earlier,
can
Sa-Dhan
send
handbook was there.
we can continue discussion. You can separately send this to Sa-Dhan and Sa-Dhan can evaluate. And if that is there, we will revise it. But otherwise, like for now, we can continue with this.
Okay, okay. Thank you.
so one question I have is, Sadaf sir, how do you take the equity cost?
Sir, of course, that is a very interesting point. And RBI also asked us, I'll tell you, sir, if you take equity cost, then you would also have to take into consideration the expected return by the investor. And investor expectation in today's scenario is in 18% and above. And if you take 18% in the numerator, and if you take the equity as a denominator, no problems on that. But since you're not taking that return expectation, then that's why equity is not taken.
Okay. No, but one point I heard from RBI is that some people are taking the equity cost very high, 25, 30 and all they are taking.
Yeah,
So
that's not to be taken actually.
yeah, that is what it happens. So better to keep it away, keep it up.
You should put it in the notes.
So a reasonable cost of equity is allowed.
Reasonable equity. So what is the reasonable?
Reasonable.
That's the question. So
Yeah, that
if you are
obviously.
within the, it is somewhere closer to the cost of your funds. I think it doesn't look.
Prashant, have you been able to convince your RBI auditor that cost of equity to be taken into consideration for pricing?
Recently, there has not been such an audit as well. We might be
That's
facing this question, but just wanted to understand
No,
how
we
far would
did.
the
We did. We had a discussion. They forced us to. They wanted us to take the equity in the denominator, but we said that then you take the expectation on equity as a cost also. But then mutually agreement was that neither of that would be taken.
Okay. No, but I think in principle it is not objected. But only thing is that it should be done in the proper manner and also it should not be very highly what do you call unusually higher amount, higher figure. Well, that's what I could understand from the discussion we had with RBI. Remember, she was telling just now. Just now I was telling that people are taking very high numbers. So hopefully it's not, I mean, in principally wrong, but then how do you work out? That is what we have to look at.
So there is a question of how to calculate the profit margin. How does the board decide the profit margin? And should profit margin change frequently?
See, profit margin, ultimately, what is that you expect out of your business? Is it 3%, 4%, 5%? What is your returning? What is the return you are expecting from that? So the board should have a view on that. It should not be very high because in you're doing a lending activity and that too lending to the poorer segment. So you can't expect that your business is going to earn you 12%, 15% ROA, which may not be correct. So you have to definitely keep that is where the question is. In fact, everybody, even RBI will not tell you what should be the number, ideal number, but we have to look at our social objective of this business also. So that is what we have to say. So any point you have?
Yeah, I think it pertains to the ROA. What is the return on asset that you want to benchmark yourself for and your board expects? I think reasonable degree of expectation is that the bank earns around, the best of banks earns around 2% ROA. And since NBFC takes higher risk, maybe it could be slightly above. But certainly, as Gigi sir said, it can't be 7, 8, 10% kind of an ROA. It could be 2, could be 4. But it's all a subjective call. You should be able to justify it. You shouldn't be looked as profiteering. You are making reasonable profit is fine.
Sir, means how to calculate it? Like if we see the last 2-3 year financials based on the average return on asset like this, we will calculate it, or how it
What
is?
is your expectation? If you conduct a business today, you will always give a projection to your investor that I'll make X amount of profit. So if your average asset under management are 100 crores, and you are saying to your management that you will make 2 crores of profit, so that is 2%.
Okay. So like, will it be changed like frequently, or like it will be constant
It
throughout the
should ideally
calculation?
be for a year.
For a year, yeah. Generally, at the beginning of the year, when you or the before the start of the year, you have a business plan set for the next year. That is where you decide what is the kind of profit you are looking at.
Okay.
Jiji sir, I have one more question.
Please, please.
Yeah, sir, we have included most of the element or the types of the loans or a debt in the while calculating the interest cost. There is one instrument which I think needs to be considered is the OCPS, optional shares, convertible shares. There is CCPS compulsory, and there is preference shares which is redeemable preference shares without any options. In that scenario, we may have to pay up some interest or probably the dividend. The wording would be the different, but it would be a pure kind of a debt which we would have taken for the tier 2 benefit. In that scenario, can we add the dividend paid to the non-convertible and redeemable preference shares or no?
No, dividend will anyway would be netted off from profits.
Profit.
And your ROA will compromise for that. So you would not be required to anything equity or quasi equity is not allowed.
There's a question there.
So, risk premium. So what is the right method to calculate risk premium, customer-wise or overall? If customer-wise, what practice is industry following?
ECL is the best way. Study the ECL method, well documented in NDIS, and it has to be customer wise. But of course, you have to see that what is the portfolio of your customers, and at a kind of overall basis, what is the credit cost that you would have to expect.
Ultimately, it's an aggregated figure, but then of course it is formed out of each customer behavior.
Yes, correct.
But then you can't.
ECL is there, sir. So
ECL is there.
The expectation of RBI is that pricing of each customer base would be on the risk profile of the customer. That's the expectation.
Right.
While calculating CAR, should we include the provision against standard assets in tier 2 capital? Also, what will be the weight of FLDG and FD? Is it 20%?
Yeah, this is again a debated item where the provision against the tier 2 capital at some places NBFCs are doing it, but we tried doing it. It was not allowed. So we have a reasonable capital adequacy. So we were okay with that. But this is again left to interpretation from the auditor. Maybe it will be worthwhile to get a clarification on that.
No, I think Sadabji, it is already there in their calculation sheet. Standard provisions is allowed as a tier 2 capital. It is very clearly defined in the RBI master directions, and the weightage about FLDG, if it is placed with the bank, then it is 100% weight. It is a risk-free asset, so you can deduct from your risk-weighted asset, and 100%. I mean, it is carrying zero kind of a risk.
FLDG does not have zero risk.
Yes, sir. It is zero risk. If it is placed with the bank, it is zero risk. Until and unless FLDG is placed with the FIs or it is placed for the securitization transaction, then you have to deduct from 50% from the tier 1 capital, 50% from your tier 2 capital. Rest is zero weighted asset. So you have to deduct from your total asset. and that has been approved by the RBI. In fact, this entire data needs to be filled up in your return, and they are okay with this.
FLDG point is well taken, but I think on the provision, again, there's a like an interpretation part of it between IGAP and ECL, the India AS,
Yes.
in terms of car calculation. But I think we can provide a clarification on this. That's fine.
Sure.
We can get a clarification on this.
What will be the ideal net margin?
See, this, I don't think so. Sa-Dhan is in the capacity to define what is the ideal margin. It's based on your board members' opinion, what should be the ideal margin for you for this business. And based on your board approved policy, that's fine.
See, when RBI say usurious, they basically talk about this part only, because other things are all they're all black and white. So how much you want to add on to that cost for your profit? That is what makes you higher or low or the acceptable. Anything else? So basically what we will do is that we will compare all these queries which you are raised. We will also try to get clarification if there are any, because I don't say that we are the experts. But then whatever is required to be got clarified, we'll get it clarified. And we'll circulate this as kind of an advisory, which I would request everyone to start using it, adopting it, and show that this is how you are arriving at your cost. Nobody is then
My recommendation would be, sir, once we finalize, we will take a blessing of RBI also onto it, and then
Excellent. Okay, sure. That can be also.
Sir, I would like to give big thanks, but I have request you just you add
Salimat here.
point at risk cost. One is what sir said,
So,
provision and
can I speak?
another is
No, 1 minute, sir. Vishwajit is speaking. Yeah, Vishwajit, please.
Sir, I would like to give big thanks to arrange
there was a
this
handbook.
platform. It has helped us a lot. So I would request Sa-Dhan to arrange this type of meeting through virtual mode, and it gives us big knowledge. I would like to request one thing to Sa-Dhan, that is risk cost. You just divide it into two parts. One is premium, just a provisioning amount, and second is write-up amount. Yeah.
Okay. Yeah, sure.
Clear for us to understand, and when RBI will come or student will come, then we can show these documents that has been decided by the HRO, and it has been approved by RBI also.
Sure.
Yeah. Thank you, sir. Thank you for my part. Yeah.
Thank you.
This is good.
Salmanji, you are saying something, Salman?
The only thing is outstanding borrowing, no? Total outstanding borrowing less security deposit, it was given by Sa-Dhan itself. The handbook of MFIs and RBI regulation and its compliance, it's there on the page number 18. So, if the position is changed, then we have to see how it was arrived at. What was the advice given, and any accounting practices, it conforms to accounting practices or violates accounting practices. That has to be looked into.
We will look into
So
that.
it can be examined.
Yeah, we will look into that.
Yeah.
There could have been some
Because
change.
once,
Yeah.
if it was published by Sa-Dhan, a lot of thought would have gone, and consultation with accounting expert, it is rolled out as a guideline to the members. This aspect needs to be looked into.
Let's see. It's, I don't know when it was published also, which year it must have been.
It is published. The booklet is there. You can see this.
Which year that was published? Any idea?
2012, 13.
No, this one is done.
Yeah, it is there.
Okay. We'll check. We'll check. Thank
Page
you.
number 18. Page number 18. This also you can see.
I know. 18. Page number 18.
Yeah.
It was 2012 or 13.
So if any contrary position then already published is taken, it should be well thought of. Yeah.
Okay. Sir. margin computation. Okay, sir, Sarvan sir, we'll look into that and in our clarification,
Yes,
in
yes.
our ways.
Yeah.
Less security deposit.
Okay. As Sadar Sahab said, we'll incorporate your suggestions. We'll prepare it once again, and maybe we'll try to take an approval from the approval means at least an consent from the RBA, so that it becomes an authentic document.
GG sir, do we have time for one last question?
Yeah, please, please.
Good afternoon, GG sir, and everybody in the call. This is Manoj from Worthridge.
Yeah,
So,
good afternoon.
GG sir, my first question, there are two questions. One is that while the RBI has been silent on the cost of equity for operations of MFI, does it mean that, in future we would see some innovative capital or, a different stack up of funding as far as microfinance is concerned? So that is my first question. And second one is, sir, since we have all legal
ಕಾಲ್ ಬರ್ತದೆ ಕಟ್ ಮಾಡ
Yeah, please go ahead, sir.
Yeah, and second one is, since we have all legal forms like the large commercial banks, small finance bank, NBFC, the MFIs, societies, and so the RBI, getting sensitive on this rate issue, is it because of any particular segment, this delivery of MFIs institutions, or is it a perfect storm caused by the new regulation, the COVID lag, which caused of huge demand in the market? Was it a mix of that, or it is a perception of the industry past, which would have happened way back in 2010, that it continues to haunt? Because these calculations and all, sir, we can do and we will implement it also, but unless the perception, especially to RBI and the people at large, is changed, this is the discussion we will be always coming back, and will be looked as even if we are trying to give our best to the industry, because while we do a lot of good things, that does not come up anywhere in the media, whether it is the strengthening of the community or probably having inclusive growth, but a slight change in perception as far as interest rate goes causes a storm in the industry. So how do we tackle that? So, sir, these are my two main questions.
First of all, I think RBI should be the one who should ideally answer that. So I'm not getting into that. Second part of it, basically, RBI, see, they are expecting that that there should be some kind of a, reduction in the interest rate because for the last almost 2 years, rates are mostly remained at the same where it was. Initially, they didn't have much issue because, as you said, the COVID cost distress was there in the industry, and that was a cause for the higher credit cost. But now, of course, now again things have become a little different. But in between, things were better. So that time, probably RBI expected that some transfer of the better environment, which we are having, a better recovery environment, that should get passed on to the borrowers. Probably that has not happened. That is the cause of it. And secondly, as you said, it's more a point which will keep coming again and again, whether it is done. But at least if you can make it show them that we are doing it in the right way, this is how we are done, then things can at least will not get into a problem of that sort. There will be still discussions happening about higher interest rate and all, which probably people are not aware about it, why it is so high. It's a reason for it. There is a cost, as I said, it's a double interpretation which happens in most of the cases. We are nobody lending from their own funds, it's all borrowed money. So when you have borrowed money, you have a higher cost of funds, and you have an operational cost which is higher than any other financial institution because of the model which we are adopted. So definitely, it's going to be a little higher than the other institutions, but then, at least as I said, it's not only that justice to be done, it should be seen to be done. So we have to create an impression that we are also doing it in the right way. So there should be some document and proper way of doing things. That's what we are trying to attempt. As regards your point of the kind of benefits of microfinance is bringing, you are right that we don't have much documented things to show. That's the reason why recently means about a year back, we, along with IGIDR, Indira Gandhi Institute of Rural Development, or Indira Gandhi Institute of Development Research, that is Mumbai. We did a study, and that study is almost final. That report is now ready with us. It should be released in another 1 or 2 months after getting it approved from the SIDBI, because SIDBI is the one who funded that study. So once it is done, we will be having a stakeholders meeting where we will be present it, and we'll also bring it to the public. We'll go to the press, which in fact there is a lot of good things which has come out in the study. We will try to make it known to people. But this has to be a continuous effort. It can't be one time effort. It has to be more of documentation, more of publicization has to happen. So we'll try to do whatever is best possible from our side. Thank you.
Thank you.
Thanks. Thank you. Is there any other question? If you have any specific points to be pointed out, like you mentioned in this chat box, thank you so much for all those suggestions or all those comments which you made, or the questions you have made, which has made us also to understand certain things. As I said, we are also not the ultimate authority of everything. So once that is exactly why we thought of having this discussion, to get your views also, so that we can combinedly come out with a kind of a template which will be beneficial and useful to everyone. So if you have any further points to be made, or you have any suggestions to be made, or any queries to be made, please send us a mail today itself, so that in a day or two we will be able to finalize the whole thing. So thank you so much, and with this we'll stop here. Thank you everyone for coming and joining this meeting, and
Thanks.
to do this.
Thank you, sir. Thank you.
Sadaf sir, I think it's logged out. Yeah, no issue. He was
Thank
very
you.
supportive. Thank you very much.
Thank you, sir.
Thank you.
Sir.
Thank you.